question. So, intrinsic value, the definition of intrinsic value is relatively simple. Calculating it in most cases is far from elementary. So, actually, it was John Burr Williams who came up with the concept of intrinsic value and defined it several decades ago, and maybe about 100 years ago. And he said that it was the sum of all the cash you could pull out of an enterprise between now and Judgment Day, and then you would discount it back to present value by some reasonable interest rate. That would be intrinsic value of the enterprise or a real estate or anything else that you're looking at. And of course, when we apply that to businesses and stock market equities and so on, it is a far from elementary exercise because projecting cash flows for a business several years out, even the insiders in the business who maybe haven't even been running it for 10, 20, 30 years may have difficulty with that exercise. Outside investors who don't have the same level of, expertise or granularity about the business would be even more handicapped doing that. At the same time, making investments without having a good sense of intrinsic value is a fool's errand. There are hacks, and we can use hacks to get to the promised land. The first hack is that we don't need to know the intrinsic value of everything, and we should not even aspire to that. Most stocks would fall outside the circle of competence of a given individual investor or an institution. So if something is not within circle of competence, there's no need to try to figure out what it's worth because we're not going there. So that becomes one, and large swaths of equities would be outside my circle of competence. So, for example, if I look at anything in biotech, as I have no edge or anything I can bring to that party. If I'm looking at industries or businesses with a lot of technology that I don't understand, again, it's the same thing. So, or if it's an industry which I just don't understand, what are the main factors that drive it? Lots of businesses go by the wayside because they fall outside of circle of competence. Other thing that we can do to put the odds in our favor is we don't necessarily need to figure out intrinsic value. What we need to figure out is it's above X, where X would give us acceptable return. So we may not be able to come up with a precise number, but we may be able to come up with a number that, a stock is trading at 50, the intrinsic value is over 80, for example. So that would give us, some basis to proceed. We can also get to the liquidation value of a business in most cases relatively easy. Sometimes liquidation value exceeds the stock price. So then again, it becomes a hack where you could say, well, I know liquidation value is more than 2 or 3 times the stock price. And I know that liquidation value is not going through degradation or is unlikely to go down. So we can do that as well. There are a number of different ways that that can be approached. I remember, I think it was 2005 or so, there was a steel company. It was headquartered in the US, but most of their plants in Canada, a company called IPSCO. IPSCO made tubular steel, basically steel that was used in pipelines. And they used to have these multi-year contracts because people are building out these long pipelines that they would place orders with, so which were firm orders because they wanted to make sure they were getting the pipe they needed. So IPSCO many times had visibility, multi-year visibility into their earnings. They had announced in 2004 that for the next 2 years, they would make $15 a share in net income after tax. The stock was trading at about 45 per share. There was about $15 a share of cash on the balance sheet. There was no debt. And we had this, next 2 years of $15 coming in. And they had a lot of other assets, plant, equipment, inventory, etc. So if you excluded everything else and you just held the stock for 2 years, the cash on the balance sheet would equal to the current stock price. So IPSCO was a very cyclical business. Even the insiders probably couldn't tell you what the intrinsic value was. But I didn't really care. My take was, okay, let's buy the stock, let's hold it for 2 years, and let's see what the market decides the company should be valued at that point. I couldn't believe that a business with $45 of cash on the balance sheet would still change hands at $45 when they had all these other assets. Their earnings could well have gone to zero in year three, or they would have fallen off 70%, or they could have stayed flat or gone up. There was a very wide range of outcomes. Probabilistically, it was a good bet. And so a year later, IFSCO announced that they had one more year of earnings visibility and they were going to make another $15 share. So now, I mean, shortly after I bought, the stock had gradually drifted up to 60. And then when they announced this one more year of visibility, etc., it continued to move higher and it was trading at about $90 a share. And I had held the shares for about a year and a half. I was saying, well done, Monish. It worked. But since we have no further visibility and we know this is a cyclical business, maybe it's time to get off the bus. And as I was running through that thought in my head and thinking about, it might be time to, we can double in less than 18 months or so. There was an announcement that came out that a Swedish company had made a offer to buy IPSCO at $160 a share. And when I woke up that morning, I think the stock was trading at 150 or 152 or something. One femtosecond after that, I sold all the shares. And that deal actually closed and IFSCO became a private company, part of the Swedish group and so on. But, that's an example of where there was more value there than what the market was ascribing. Sometimes the market gets confused with risk and uncertainty. There's a business I invested in 2019 in Turkey, which is the largest warehouse operator in Turkey, Resas. And their liquidation value, which was relatively easy to get to because they had 12 million square feet of Class A prime warehouses, 20% were refrigerated, 99% leased, 10-year inflation indexed leases. The market cap was 20 million. The liquidation value was over $1 billion. And there was about 200 million of debt. So if you took out the debt, you were buying something for 3 cents on the dollar or something, 2.5, 3 cents on the dollar. Again, in that case, there were cash flows and other things going on. Intrinsic value was probably over 800 million, but they were very good capital allocators. My estimate by the intrinsic value might be 50% for liquidation. But I didn't need to figure it out. We were buying at 20 million and liquidation value was 800 million. Good things were likely to happen to us. So there's another company, I think in 2015, Rain Industries, we still own it. This is a very cyclical business with some significant volatility in earnings, but they're also low cost producers. So they don't really make money even at the down cycle. Rain Industries had a market cap under 200 million, 2 billion. There was a very high probability I felt that in the next 4 or 5 years, earnings in a single year would exceed 200 million. And again, I just wanted to hold the stock to see what happened when that single year earnings went to that number. And I thought that odds were high, it would happen within 5 years. So my take was, okay, we don't have a downside. We have an unknown upside and can go in. We don't know what intrinsic value is, but that's okay. Within 3 years, their earnings hit the 200 million and the market cap got close to 2 billion. And in my infinite wisdom, I did not sell because by then I was in love with the business. And then it went down. And now I think it's about 700-800 million or so in market value. So we have a gain, but and I think we will get past the old 200 billion in the fullness of time. But that was another example where you couldn't lose money. You didn't have to figure out intrinsic value. So I think the hacks are important because many times a straight DCF. So one of the rules I use is that if you need Excel to figure out what the intrinsic value is, there is a problem. If you cannot do it in your head, there's a problem. If you look at a business like Starbucks or McDonald's, for example, I think the odds are very low that these businesses have lower earnings 5 or 10 years from now. those are pretty low odds. The place with the area which gets complicated is how much higher would, right? And so you can always take a conservative view on these businesses and say, okay, well, I've got a long history with these businesses. I can look at the history. I can look at it. China's got 5,000 stores and maybe it could be 10,000 in 5 years or something. Those sorts of things, and you could make some extrapolations. Those those types of bets can pay off extremely well. The math is a little bit more. It requires you to make more assumptions than I need to make with RASAS or RAIN or IFSCO and so on. But that can work as well. But the important thing I think is that because we live in a world with 50,000 listed companies, there are always businesses and regions and industries that are going through some kind of overhang, which is making it easier to get to at least floor intrinsic value. And so focusing on those is a good way to go. Like I think Buffett has a quote. He says, we like to buy great businesses when they are on the operating table. And so I think a lot of great businesses go through temporary hiccups. And the temporary hiccups can help us make it easier to figure out intrinsic value and get in at a price below a conservative assessment.